Good afternoon and welcome to another VSA Capital Tech and Transitional Energy podcast. And it's February the 5th. I'd like to welcome on the podcast this week as Andrew Monk, my normal sparring partner, is away on business. I'd like to welcome David Scriven from our sales team. David, how are you?
It's a pleasure, Phil. Good to be back on the Tech and Transitional Energy podcast. But I think we've got the short straw. I mean, Mr. Monk's in Cape Town. Look outside there. It's all dark and dreary. He's probably got the lovely sun.
This is factually correct, David. I think we should move on swiftly to the market.
Exactly. So I thought I'd start off just talking about crypto and then go into ETFs and we'll explore some very interesting news that's come to markets over the last several days. So firstly, on crypto, almost $500 billion has been wiped off cryptocurrencies in less than a week. While precious metals found buyers on Tuesday after recent losses, cryptocurrencies failed to attract support. Bitcoin has not acted as a safe haven during a period of heightened political uncertainty, e.g. the US-Iran tensions, and has exposed itself as a speculative asset on this occasion. So I think this is something that needs to be kept an eye on. But deferring to my more usual angle, and that is looking at the ETFs as a way of going through the US. So in terms of, and Europe, clean energy, it's making 5-year highs. Now, on the strong side of the ETF contributors, one of the key ones has been NextEnergy. The 3Q beat and the forecast for 2026 guidance was raised for the third consecutive time. Now, on the weaker side of the equation, Canadian Solar expects 2025 net profit to be down between 50 to 60% versus 2024. Impact from trade protection policies and higher costs such as polysilicon and silver paste are to blame. After a strong share price run in Vestas, it's down 7% today after the company forecasts revenue for 2026 of being euro 20 to 22 billion, as analysts point to stronger order momentum but slightly weaker revenues than expected. Softer revenues are attributable to weak onshore turbines and services. Now, really interesting news over the last several days have been in the AI and software space. The launch of a new AI automation tool from Anthropic to handle legal workflows such as contract renewal, compliance, and documentation analysis triggered a sell-off in legal software, data analytics, and professional services stocks across Europe. The brunt of that sell-off was in professional publishing, e.g. Relics and Wolters Kluwer, but other names impacted in software and IT were Sage and SAP, and in ad agencies, WPP and Publicis. So I think this market is in need to differentiate between disruption, new and distinct solutions for customers that are hard for incumbents to embrace, and sustaining an innovation that can be adopted by incumbents to enhance existing products. These terms come from Clayton Christensen, a Harvard professor, and is discussed in CityWire, a CityWire article on Adobe, whose PE has fallen from circa 50 in 2020 to around about 10 times now. Now, Adobe falls into the sustaining category by the adoption of a panoply of third-party AI models into its software, as well as developing its own in Firefly AI. Excuse me. The strategy has included over 5 billion in recurring revenues from products within AI features. The element of disruption needs context in that software companies can manage mission-critical tasks like payroll and IT management and require deep subject matter expertise that goes well beyond the actual coding of the software itself. So the market may be selling off indiscriminately, and bargains in sustainers will emerge. Now, interestingly, on Tuesday, Jensen Huang of Nvidia, said, "There is a notion that the software industry is in decline and will be replaced by AI. It is the most illogical thing in the world. Software products are tools, and AI will use these tools, not reinvent them." Now, the real bellwether in software is naturally Microsoft, whose share price has been pulled down, in part due to the reporting of slowing growth at its key cloud computing platform. And we should look out for news today on Amazon's cloud business. The sentiment mix is complicated by Microsoft being in the software sector and being a hyperscaler in that CapEx camp, where an increase in CapEx saw Meta's share price rise, but Microsoft go in the other direction. And it's just such a fascinating area. Phil, I'd love your thoughts on it. Plus, I know you've got some comments on Alphabet.
Well, yeah, I mean, I think, David, what you said about software is true. I mean, in my view, so much software has been designed around specific use cases, as you say, like HR, like finance, business, business operations software. There's all layers to this software. It's not just about being able to very cleverly find information, but it's structuring all the information together, but doing it in a way that can be manipulated by specifically by areas of expertise. And I say, be that HR, medical, finance, you name it, industry specific. So yes, I think just right now it does feel like there's a bit of a bit of a sell off going on, but it will gradually correct itself, and we'll see what happens with the sort of tools that Anthropic is proposing. This is the plugins that it's proposing. I mean, for sure, you will be AI. There will be AI assistants assisting with specific tasks and automating those tasks. But will AI overtake all of these embedded softwares? I'm not so sure at this stage. I don't think so. And you kind of think about Microsoft as well. I mean, Microsoft was a fantastic way of organizing, originally with Windows, of organizing your information in terms of your directories, your filings, then organizing any software programs that you have, all in one fantastic interface tailored to a user case. So, when you try to replace these things, yes, I think it's some way off, but certainly the growth of AI assistants, we will see. But yeah, I mean, getting on to Alphabet, who reported yesterday. I mean, the numbers are still quite mind-boggling in terms of their business and growth. They reported annual revenues of $400 billion. And in the most recent quarter, their profits were up by 48% to 34.5 billion. I mean, I remember the days where we used to look for growth that was kind of well above, a bit above GDP plus inflation. 48% growth. So clearly there is fantastic demand for their services. They've also forecast capex spending now of 175 billion to 185 billion dollars, which is well ahead of analysts' expectations of 115 billion. And again, it's just utterly astonishing that they can deploy that sort of capital. Spend it within a period of time, be able to buy in all of the equipment they need, the software they need, and and spend on staff. So quite astonishing. But we're getting to that phase of the AI story now where the capex is being deployed, and we're starting to see, look, how is it impacting end business? So where is it actually adding value, and where was AI going to be generating returns? So lots going on, obviously impacting the stock markets. What was very interesting was an article in the Financial Times today about the S&P performance. Now, the S&P 500 Software and Services Index has slid by 13% in the last 5 sessions. This according to Reuters. But the FT noted that for the S&P 500, since Monday's close, 79 components have fallen by 5% or more. 93 have risen by 5% or more, and overall, the S&P 500 is actually up. And they also noted in an article I saw this morning, October 29th to January 15th, sectors like materials, healthcare, energy, financials, and industrials were all rising while tech was falling. So maybe, given all this, the environment of uncertainty at the moment, there's more of a shift into value versus technology growth as things play out.
Yeah, that sort of brings me back to Adobe because it's now gone up to a 10 times PE. The stock has dropped over the last several years. You're now actually at a point where surely, this got this 5 billion recurring revenue stream now. They've adopted AI tools, sorry, AI.
Yeah.
So
yeah.
Now it's probably at 10 times.
That's what an engineering company PE, advanced engineers.
But
Yeah.
also, when you touched on this growth that we're having, it's just simply phenomenal. But the street is obviously putting back on some because they've got even enhanced expectations beyond that. Because Microsoft's results were a beat.
Yes,
on all
they
sides.
were a
They
beat.
were a beat.
Yeah.
And then this capex I was seeing in Bloomberg that collectively the hyperscalers estimates they put for capex was 200 billion in 25, and it's going to go to 400 in 26. It's just simply astounding.
I don't know. What's going to be very, very interesting is exactly where is the capex getting spent, and drilling down on that, and then of course drilling down it's into the companies that are benefiting, downstream from all of the capital expenditure. We've talked about quite a bit of that already in the podcast, but more to come in that area for investment. So yes, we live in exciting times. It isn't dull, is it? And then if you own gold and silver, it's not been dull either in the last couple of weeks. Okay.
So just following on from that a little bit, I just wanted to give credit to Polar Capital because Ben Rogoff and team have been calling caution on software stocks, and their portfolio weighting is expressed within that. In other words, they've got semiconductors and semiconductor equipment is 33%, software is 7.9%. And it's well worth listening to their podcast on their website in a discussion on AI maximalists, for which they are, on the 30th of January. Well worth tuning in on that. And that leads me on to, with their overweight on semiconductors, to then come into the subject of that and the SOX, which is lower following the news from Advanced Micro Devices and Micron, which has taken the momentum out of the index, which has up to now basically doubled since April 25 to late January 26. Now, AMD, Advanced Micro, suffered its worst stock decline in nearly 9 years after the chipmaker's sales forecast underwhelmed investors. A sign it's not making AI inroads that Wall Street expected. Now, Q4 sales and profit beat expectations, but Q1 of the following year's sales forecast of 9.8 billion plus or minus 300 million underwhelmed some analysts who were looking for an estimate of 10 billion. Now, Micron dropped 17% despite reporting a record 10.3 billion in Q4 revenue, as investors worried that growth was driven by one-time sales to China. Now, CEO Lisa Su said that the China-related boost was a backlog clearance, and forward guidance showed a sequential decline. The cautious China sales sentiment was in lockstep with AMD, who reported ahead of them. So that was sort of my thoughts on the tech side.
Yeah, I think the other thing is especially for the semiconductor companies. I mean, ultimately, those semiconductors are going into computer servers, which are going into data centers, and it becomes about the pace of capital expenditure deployment, i.e., how quickly can people build things? And the data centers, for instance, it's all about there's things like getting planning permission, access to water, access to grid connections, and the power supplies. So, I think probably with some of the semiconductor companies, we're going to see more sort of fits and starts with some of it because of the pace of actual deployment over time. But we will see. But I mean, AMD, that was quite an impact on their share price, which just shows how sensitive right now the markets are.
Yeah, indeed. And it sort of lends itself to the sort of, if you could describe it as a sort of picks and shovel approach for which Polar are taking.
Yeah, that's right. Yeah.
I think I may have mentioned it, but I think I may have forgot to mention it. But just reading back a little bit on that software sell-off, names like CrowdStrike, Palantir, Palo Alto, Checkpoint Software have all dragged down the other ETFs that have tended to follow, like cybersecurity and NATO defense.
Yeah, they are. I mean, those ones that you mentioned are mainly cybersecurity companies. So, but they've enjoyed a good, quite a run up. And of course, Palantir, there's been plenty of comment on its valuation. So, yeah, that's come off. Well, there we go. Well, it certainly isn't dull, David. And thank you very much. Thank you very much for talking about that, talking about the markets. I mean, just in the case of the UK, a little bit closer to home, it's been pretty thin on news this week. In terms of trading updates, we've obviously had a good number of those in the last couple of weeks. What I did notice, though, was Filtronic, tickers FTC, market cap now £432 million, one we've discussed a lot on this podcast. This is electronics, it's radio frequency technology that's used in satellite amplifiers, but also defense, electronic warfare. Their interims of revenue slightly down to £25.3 million. They pointed their cost of goods sold were up by 13% to £11 million. And employee costs 29% higher. But I would note with Filtronic, it's seen tremendous success with Starlink. It's moved to new operations, it's expanding, it's recruiting, and it is investing in the business to grow it further. So, to my mind, if the employee costs are higher, well, maybe better than doing a share buyback at this point in time, given how uncertain share prices are. Nonetheless, the company said that it's got around 90% of its the estimates in the market for 26 covered by contracted orders. Quote, demand across our space and aerospace and defense markets remain robust. So that was Filtronic. Bit of action here. Cyan Canode, ticker is CYAN. Share price was 6.25p at the end of Jan, and it's now 8.7p, 30 million market cap. The company has Internet of Things and smart metering technologies. Put out an RNS, noted the share price had risen near term and confirmed that it's received an indicative non-binding approach from Dubai-based Easiasoft Holdings at about £35 million. The company in April announced its Indian subsidiary had been awarded a £70 million contract to deploy around 750,000 smart meters, and that it's got an outstanding order book of £180 million. So we'll keep an eye on that one. So that is Cyan Canode. ITM Power, ticker is ITM, 380 million market cap. I don't think we spoke about this last Thursday, but it had then it reiterated its guidance for the full year. This is electrolyzer technology. Shares are up by 75%. Been listed for a long time, so this is all to do with green hydrogen electrolyzer design and production. They reported 80 million of revenue, up by 16% from the prior year. Losses expected to be about just under 12 million, but were 16.8 million the year before. And this company has plenty of cash on the balance sheet. It's guiding 170 million to 175 million at year end. So there we go. So that was ITM Power, and that's it. There weren't any other. I don't know if there were any others that you saw, David, I might have missed in terms of trading updates.
No. I think let's have a look at all those software names in Europe that took a slide. I mean, I noticed a few were recovering a bit today, but see where it pans out over the next few days. See if they stabilise or. And
it's going to be. It could be a really interesting opportunity. Because I mean, if you think about some of these AI, the US AI companies are so well funded that actually it may benefit them just to buy these, because it will give them all of that added structure, sector expertise, market penetration with all within customers within the specific areas like HR, legal, or whatever. We will see. It's very, very interesting what's developing here. And with that, David, thank you so much for joining us this week. And as always, as Andrew and I say, that if there's anything you think we've missed, any companies you'd like us to look at, any ideas for the podcast, it's all gratefully appreciated, and do feel free to write for us. And we look forward to hosting another Technology and Transitional Energy podcast next week. Thank you, David.
Thank you.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.